Hey, so you've got a company car as a perk. That's awesome, right? I mean, it's one of the best benefits you can get. But let's be real, it's not exactly free. See, the tax man always wants a slice of the pie. And in this case, it's called a benefit in kind, or BIK for short. So today, we're going to break down exactly what that means for you, specifically for the 2025/2026 tax year. So here's the big question we're all asking. Is that shiny company car a genuinely great deal? Or is it a sneaky little tax trap waiting to catch you out? Well, let's figure that out together. Stick with me, and by the end of this, you are going to know exactly where you stand.
All right, first things first. Is it a perk or is it a problem? To get to the bottom of that, we've got to understand the core idea here.
Okay, so what on earth is a benefit in kind? Think of it as basically any non-cash perk your employer gives you that, has a real monetary value. And because it's worth something, the tax office, that's HMRC, looks at it and treats it just like income. And we all know what happens to income, right? Yep, it gets taxed.
Here's probably the easiest way to wrap your head around it. Let's say your boss handed you a £1,000 cash bonus. You'd totally expect to pay tax on that, right? Well, a company car is basically just a non-cash bonus. The value is still there, so guess what? The tax is too. So you might be thinking, okay, but how does the taxman even find out about this? Well, every single year, your employer has to fill out this special form. It's called a P11D, and on it, they report the value of all your benefits. And that form is the trigger. That's what kicks off the whole tax calculation. Okay, moving on to Section 2, decoding your company car tax. Now pay attention, because this is the big one. Getting this right can literally save you a serious amount of money. I know, tax calculations can look super complicated at first glance. But trust me, this one breaks down into three pretty simple parts. First, we've got the car's official value. Then, we factor in its environmental impact. And finally, we apply your own personal tax rate. So let's take a quick look at each one of those. All right, step 1, the P11D value. This is super straightforward. It's just the car's list price, including that and any optional extras you've got. Easy. Next up is the BIK rate. And honestly, this is the most important part. It's a percentage that's all based on the car's CO2 emissions. Basically, the government uses this to give a little nudge or a big shove to encourage greener cars. The cleaner the car, the lower the rate. And finally, we just multiply that by your personal income tax rate. Whether you're on the 20%, 40%, or 45% band. And here's how it all comes together in one simple formula. You just take the P11D value, multiply it by that bike percentage rate, and then multiply that by your tax rate percentage. And voila! The number you get at the end, that's the total tax you'll have to pay for having that car for a whole year. Oh, and a quick heads up for any diesel drivers out there. If your car isn't what they call RDE2 compliant, that's the latest emission standard, HMRC slaps an extra 4% surcharge on top of your BIK rate. And trust me, that can be a really nasty surprise when you get your tax bill. So with all these potentially high tax rates for petrol and diesel cars, you might be wondering, how can I make a company car actually work for me? And that brings us beautifully into Section 3, the massive advantage of going electric. Okay, prepare yourself, because the difference here is, it's absolutely staggering. A typical petrol car with high emissions could land you with a BIK rate of up to 37%. But a fully electric car, we're talking zero emissions. And for the 2025 to 26 tax year, its BIK rate is just a tiny, tiny fraction of that. I mean, just look at the scale of that difference on the screen. It's wild. We're talking a potential tax rate of 37% versus just 3%. For a car that costs the exact same amount of money, the tax you save by choosing electric it's absolutely huge. Seriously, if you remember just one number from all of this for the 2025/2026 tax year, make it this one. 3%. That is the BIK rate for fully electric cars, and it's no accident. The government has deliberately set it that low as a massive incentive to get us drivers to make the switch. And hey, it's not just the fully electric cars that get all the love. The best of the best plug-in hybrids, we're talking about the ones with a pure electric range of over 130 miles, they can also qualify for that same incredibly low 3% rate. Pretty cool, huh? All right, let's pull all of this together now, because once you understand how the system works, you're in a powerful position to make a really smart choice for your wallet.
Now, we've spent a lot of time on cars, and that's because, they're usually the biggest ticket item. But just remember, this whole benefit in kind principle applies to a bunch of other perks too. Things like private medical insurance, gym memberships, or even that company laptop if you're using it for personal stuff.
So what's the bottom line here? The big takeaway? Right now, choosing an electric company car is not just about being good to the environment. That's great. But with the tax rules as they stand for 2025/26, it is without a doubt a seriously smart financial move.
So that really just leaves one last question for you. With tax savings this massive on the table, is an EV your next smart move? Honestly, when you look at the numbers, it's a question that every single company car driver really ought to be asking themselves. Thanks so much for joining me.